Okay guys, thanks everyone for attending tonight's webinar hosted by FP Markets and presented by Evan Lucas. Today, Evan's going to take you through a top-down macro perspective for trading global markets. Now, for all those that are tuning into the webinar tonight, there is a bonus offer. For all new IRIS accountants, we'll be giving a bonus commission rate of 0.1% with no minimum charge. So, for example, if you were to place a $1,000 trade, that would only cost you $1 in commission. Now, for MT4, all initial deposits will receive a 10% bonus trading credit up to the value of 5,000 Australian dollars. For full terms and conditions of the promotions, you can visit the FP Markets website under the About Us promotions section. I'd also just like to remind you of our referral bonus for referring friends and family. So for MT4, depending on the initial deposit, you'll receive a cash bonus that is withdrawable to your account. Now, as you can see on screen, they are tiered, starting from a $50 bonus from $500 to $99, up to a $300 bonus for $10,000 plus. With IRIS, we also offer a cash bonus of $100 for yourself and $100 for the newly referred friend. Now, without further ado, I'll now pass you over to Evan for tonight's webinar. Thank you.
Good evening, guys. I hope you can all hear me as well. If you can, just very quickly, just also give me a bit of a heads up and making sure that you can actually sort of see what's going on. I'm sort of just making sure that you're all out there. I'm pretty sure you can hear me, and going from there. As Chris said before, thank you so much for tuning in and listening. But as always, with everything that we do in all markets, if I can get it to actually move, apologies. It's always the way, isn't it? We always have technical difficulties right at the start. Apologies, guys. Let's try that again, shall we? There we go. So as always, please just have a good read on screen. Everything in this is general in nature. Nothing that I say in here should be taken as any form of personal advice. As you can see on screen, FP Markets has a fairly good disclaimer there that I should get you to read through. So what I'm going to talk to you about tonight, and what is, basically my major thing, is that I love talking about markets. I absolutely love their reactions to what happens globally, how global economics and macroeconomics for that reason sort of moves things, how the momentum of economics sort of filters into the markets, and therefore what that actually means from a trading point of view as well. So all of that sort of what I love to do and what I love to talk about, and how I'm sort of probably going to lay it out tonight in terms of what I talk to you about. So for those of you that follow markets very closely and knowing basically how FP Markets do talk, I know you will. You're either really into it or learning about it or have been doing it for quite a long period of time, depending on where you are across the spectrum. All of that is what I'm hoping to bring to you. So if you have been listening over the last sort of 18 to 24 months, everybody's been talking about global growth. Everybody's been talking about the fact that it's been almost synchronizing, and it has, particularly at the back end of 2017, really, really strong momentum pull forward. But what we've started to see is that synchronized global growth is just ever so slightly, and I'm certainly not sort of calling the end to it, it's starting to desynchronize. And there's reasons behind it. There's a lot of interest around geopolitical tensions. And as you can see on screen, I deliberately want to talk about what is coming out, in my view, as the biggest risk to markets. It's geopolitics, and it's the White House, and then how you actually position yourself around that as well. And therefore, what does it mean for us? What does it mean from an Australian-centric perspective? What does it mean from an Australian-centric trading perspective? Because I think knowing what we do and knowing how we do it, you'll always have Australia as a base model because it's where we live and breathe. You will therefore be able to feel it a little bit better than probably looking from afar internationally. I live and breathe and sit on terminals all day, so I sort of get a little bit more. But even I will admit that I use what I see overseas to basically look also from an ability to come home, because I know that I prefer to trade the ASX and I prefer to trade the Aussie dollar. It's something that I live and breathe, as I said, and I get all that into it. But it doesn't mean that I don't look at the S&P. I don't not look at the DAX. I look at the Euro. I look at Dixie for reasons. So all of that is where I'm at and where I give you a start. So let's sort of move with that, and why I'm starting to say that things are just ever so slightly starting to unsynchronize. So the start point is this slide. I think the last time I did this for you guys was, this is the IMF, and they're always a really good benchmark. And the reason I say that, they're normally the last to move in terms of moving their overall ability and sort of belief about where the world sits. So as you can see from what it's telling you, is that they actually are relatively positive on this year, and they're also relatively positive on next year as well at 3.9% GDP growth. I'd probably cast your eyes down at what's going on in the States at 2.5 and 2.2. I'd also highlight, the Eurozone as a whole, particularly Germany, and putting that there. And then the emerging market side of it is also quite interesting, is that you can see that emerging markets this year and next year, 4.9 and 5.1 are growing. But look at China. China is expected to slightly fall down. And that is quite interesting. Something that I won't talk about today, but it is certainly going to be a topic in the future, is India. Are we as a nation and are we as traders ready for the fact that India, as of about 48 hours ago, overtook France as the 6th largest economy on the planet? And that's why I wanted to show you this chart as well, is that you can see at the bottom there that they're growing at a very decent clip and are expected to grow at quite a decent rate over the coming years. And that, I think, is a really important thing to sort of highlight. So growth is there. Growth is expected to maintain for at least sort of 12 months. But what I would say about this is it's slightly influenced by other factors, and that's sort of where I come to next. And that's what this is here. This is a brilliant chart from Goldman Sachs. If you have ever seen what they call their activity indicators, and they call it their core activity indicators, that's what that CAI stands for. It's a combination of all things, and that is things like PMI indexes, it's also inflation, it's employment, it's all those kind of things all crowded into one index. And it gives you a really good view about where the world is going over the coming period and what's been happening basically since, and I really do like to highlight the sort of the line there that's in that sort of February month, is that you can see that fall off in March is when we started to get geopolitical influence. And you can see that the nations that are here that are starting to move away are basically manufacturing export nations. So you can see the Eurozone has started to move back from what was a reasonable indicator. You can see that also the US started to slow down, but you can see the Chinese story is there, and I'll come to that as well. But this is just starting to show me that looking forward, despite the fact that the IMF is telling me that they are expecting to see growth, and I still believe it will, and it will take a bit of time, there are forward-looking indicators that are just showing signs that weakness is possibly coming. And if you remember from the point of view that markets try and price at a 12-month view forward, this has to be part of your thinking, and therefore it has to be part of your positioning. And what is now starting to appear from the back of that is that you can also see that in this slide as well. So this is the composite PMIs. This is, again, a breakdown and further of that Goldman Sachs sort of numbers that I just showed you. These are the forward estimates around services PMIs, around also manufacturing, does throw employment in there as well, and it basically puts the retrospective and forward estimates together. And I've put out there pretty much the nations that I really want to talk about tonight, being ourselves, the US, Europe, China, Japan, and emerging markets. And I've put a moving average in there, and you can just see that it's been an interesting period, and that drop away in March is something I'll come to. That is clearly around geopolitical risk. It's why I've highlighted it. But you can see that, unfortunately, even though it bounced off after what looked like rhetoric, when it became more of an actual, excuse the pun, is that the momentum has now started to slow down again, and you are starting to see issues in currencies, and I'll come to that in a minute. You are starting to see slight issues in the movement as a synchronized growth, and that's why I'm highlighting this. So you saw that with regards to the European Union, and you can see in this chart very clearly that the EU was really motoring along on those grey lines and has dropped away dramatically off the back of risk, off the back of manufacturing slowdown and demand for their goods. And that is very, very clear from what's been coming on, and that is my next thing. So what that then brings me for is that the apologies. Apologies, guys. I'm having a little bit of trouble with my computer. I do apologize for that. So what we're going to come to next is a little chart that I really quite perfectly sums up the other thing around this. and that is what is going on at the moment is that we are having a scenario right now where you've got perfect, almost Goldilocks scenarios. And what I mean by that is that, as the little girl with her little thing there shows, that we haven't got high inflation globally, which is a good thing. We haven't really seen recession, but there is certainly risk there. But we've got a scenario where growth is really motoring, but we've got low inflation. We've had this Goldilocks scenario, and that's why I've highlighted this title as the capital, because part of all this growth, part of the reason we've come from where we have been in the past is this scenario. We haven't had any form of inflation that's really motoring out of control. We've had no real scenario that we've seen a huge amount of tightening yet, and I'm about to come to that. And again, having great fun today. We're having also a scenario where inflation is starting to materialize in the States, but not really anywhere else. So all of that's there is why we've had this Goldilocks scenario. But what's now starting to happen is moving to what I really love to talk about, which is the central bank sort of conundrum, which is that the Fed is pretty much ahead of everybody else. It is in a scenario where they are starting to see signs of inflation, not a huge amount, but it's there. They are pulling the trigger on rates, and they've been doing that now since basically the end of 2014. We've seen 7 rate rises to where we are now, and that's what this chart highlights. This is the Fed dots plots, and for those of you that follow the Fed quite closely, you'll understand that those yellow dots are the members that are on the FOMC committee, and their expectations of where the Federal Reserve rate will be come the end of 2018, 19, 20, and the one on the far right is their longer term view of what they believe is the nominal rate. So the normalized rate for the US is where they currently see it, and you can see it sits there roughly at around about 2.75, 2.8% is what that green line, that sort of median line, is telling you. But what's very interesting is that this has changed quite dramatically of late, and we've seen that in June they actually brought forward the idea of this year was supposed to be 3 rate rises with probably 4 next year. So they've now brought that forward to be, according to this chart, and what they're actually telling us is that by the end of the year there will be another 2 rate rises. So come September and December, and the reason I highlight those months, the Fed has a little bit of a strange scenario where they only have press conferences on the quarters, and they tend to therefore only be able to announce rate changes on those quarters because they have to testify in front of Congress and in front of the media around why they've actually done it. So there won't be anything coming this month or in August, but come September, and as you can see on the chart on screen, that the majority of members see the rate at the end of the year basically being almost at around about 2.5%. Now it's a little bit lower than that, but if you look at where we are now, which is 1.75%, to get there, they're going to have to raise rates 2 more times, so 50 basis points to get up there. And that is the interesting scenario, is that this is starting to sort of move the Goldilocks scenario away, particularly the fact that the US has been almost the funding source for pretty much since the GFC around global markets. And the reason for it is what they're now starting to see on this chart. And this is a really, really important chart, is why the Fed is now starting to really ratchet up rate rises, why you are going to see a little bit of volatility, a little bit of slowdown in global growth, is because they actually believe that US inflation is materializing. So this is their latest views of in US inflation, and why inflation is so core to what we do as traders is that it affects, as I said, rates, but that will therefore mean that it will affect currencies, because currencies will flow towards nations that see inflation rising or falling for certain reasons. So as you can see very clearly, that they now believe that PCE, so that's the private consumption expenditure index, which is their core measure, along with the top right one, their core PCE, moving to 2%, or roughly around about 2.75% on core. They want it to be at 2. Now, the way things are moving in the US, and that's the really interesting thing about all of this, is that in the US at the moment, they have a scenario that we would just absolutely kill for in Australia, which is, I would argue, full employment. And the reason I say that is that they have an unemployment rate at basically 4%, the last non-farm payrolls. It's been as low as 3.8%, the payrolls before that. They have a participation rate of about 65%, really, really strong. They have an employment growth average of about 200,000, which was, again, the Fed's mandate. But the big thing is wages increases and the underutilization rate. Just to explain what that is, that's the unemployment rate plus those that are employed but want to actually work more. So that's like part-time, or they might be on a 4-day week out of a 5-day week possibility, on a full-time contract, etc., etc. And it's currently sitting at around about 7.8. It's been as low as 7.5%. To put that into context, and we've got our employment numbers actually on Thursday. So tomorrow you can see it sits at 7.8%, as I said. Here in Australia, it's 14, and it is rigidly high, unfortunately. And what you would hope to start to see is it start to come down, and it hasn't really moved yet. So although we've had really strong employment in this country, it just hasn't filtered through like it is in the US. So when you have wage growth moving quite nicely, employment growth at a level that it's been, you start to therefore have a scenario where employment mobility picks up. It also means that the level of skills start to short, again, pushing wages up further, and therefore people start to feel more confident in their job, more confident in spending and their current personal finances, and all that leads to inflation. And that all gets back to this chart, which is why I've left it on the screen and why I've sort of talked ever so slightly on it. And I think that needs to be core to it. So what has that meant? What have we seen off the back of that? You've actually seen quite a trade movement around Dixie. So this is the US dollar basket, and that is really clearly showing you that you can see basically, if you've got that as your base case, and that's the gray line across there, that Euro's fallen away, and this is Euro dollar. You can see that also cable, Aussie dollar has all moved away. The interesting one that's haven't really shifted, and that's what you should probably expect with what we're talking about, is that risk off currencies, being the yen and also the Swiss franc, have managed to hold fairly steady. And that is what you'd expect with the current environment that we currently see. And it's what you'd expect to see with the scenario that we currently find ourselves in, is that at the moment we have a Fed that is where it's at a level that is sort of pushing us away from where we should be. And for that reason, it's quite interesting off the back of it. So the other thing it's also meant is that I've also wanted to show you, therefore, why, with all those scenarios in there, why the S&P has completely outperformed the rest of the world. So this is a chart. It's the S&P versus the MSCI World Index, excluding the US. And it's only going back over the last 6 months. And the US has had a fairly choppy period. People will talk to you about the fact that it looks fully valued. A lot of people will talk to you about the fact that it also, has been reaching record all-time highs. How can it keep going the way it is? Well, it's a growth market. And in the growth market that we still have, and you still have to highlight that we still have, it is very much the area that you want to be exposed to. It's the area that you sort of want to be around for that reason. And that outperformance is likely to continue in the short term. And the reason for it is this chart, is we've just started basically US earnings season, and fundamentals, thankfully, are trumping the macro, which is exactly the way I would frame it, which is all of this geopolitical risk is certainly something that I am very cognizant of into the future, and the S&P is not the market that I'd actually therefore like to be against, because it does have the fact that the US economy is powering ahead quite nicely, as I've just talked about. It does, yes, have a tightening scenario around it, but the underlying fundamentals show you very clearly on this chart that they're incredibly strong. So EPS growth year on year is expected to actually grow at 20%. And so far, with the results that we've had through, barring what you probably saw with Netflix, that's a sort of a side issue. EPS growth in the States so far has been roughly around that. It's a little bit under it, not by much, but it is close to it. And we're only talking about a handful of the 500 companies that need to report for the S&P 500 to get there. So there is bottom-up support in the short term that really, gets me to believe that that is where I will be, and that's sort of what I want to be involved with. And the S&P is showing you, and I'll go back to this chart again, is that it is likely to weather the storm geopolitically wise better than probably most others. And that is, again, what you'd expect with the scenario that we have. It's what you would expect in this current market, where at the moment you do have the emerging markets going through a bear market. And that's not surprising considering what we're going through and what we're having with geopolitical issues. And with that in mind, that brings me to the next part. And that next part is why at the moment the White House, from my point of view, is the single largest risk that is facing global markets. And it's facing an interesting conundrum, and I'm sure you're all fully aware of what went on over the weekend. I'm sure you're fully aware of what's been going on basically since March 1st, when the President of the United States came out and said that he was going to put tariffs on aluminium and steel, and we almost don't talk about that anymore, of between 25 and 10% respectively, particularly aimed at almost anybody. And nations, including ourselves, had to scramble to explain why they should be exempt. Now, Australia is, but even their largest trading partners like the European Union, like Canada, like Mexico, which are part of NAFTA, are exposed to this. And this is why, at the moment, the interesting scenario around all this is that geopolitical risk is above and probably slightly still sanguine through markets, but it's there. And that's, again, why I wanted to show you this chart, because a lot of people will concentrate on the Chinese story, and so you should. But this is actually showing you very clearly that it is the epicenter of everything White House risk. And the reason I say that is that it isn't just the 50 billion of already enacted Chinese trade tariffs, along with the steel and aluminium tariffs that you can see on the left-hand side of that chart. It's the additional 200 billion, but also the fact that there are almost $300 billion worth of additional tariffs coming at the rest of the world. So it's not just a China story. This is why it's such a risk to everything. It's why it's such a risk to what could be a big, big shake-up towards the back end of the year. And it's really hard, because I actually was really bullish on the world, and have been quite bullish on the world from basically the end of 2016, because we did have that Goldilocks scenario. But what is flashing in front of my eyes, and the attention that's caught, is catching my attention, you can't not go past it, is that this unfortunately is creating a trade across the world at the moment that is going to see more and more of this growing, and more of the White House using this as an ability to push its own mandates, away it goes. So I'm going to go a little bit granular here. I hope you can sort of stay with me, and I do apologize for doing this, but I do really wanted to show you why the base case reasons that we can talk about from the whole scenario here around China and I'll come to it in a minute, also what's quite interesting about Europe. So I'm sure you're all fairly aware of the very, very large deficit that the US runs with China. And this chart highlights it perfectly. You can see it's been growing at pretty much almost an exponential rate down. The interesting thing about it is, and what is always interesting listening to the rhetoric around it, is that if you look at US GDP, 55–60% of it is consumption. It's a similar story here in Australia. And if you're a consumption nation, you're genuinely going to run, in the main, you're going to be running a current account deficit. So you're going to be running a trade deficit, sorry. And that's basically what happens. I mean, the US is the largest consumer of Chinese goods. And it's not surprising. They love, cheap, simple materials, and China does that very, very well. And it's been, therefore, as you can see very clearly from this chart, doing it for several decades, and basically since the Chinese economic revolution started back at the end of the Deng presidency, back in basically 1992. It's been the way it has. And this is an example of what President Trump absolutely hates, because he sees this as unfair trade in his views. Putting the politics aside, that's a conundrum for another day. It's more around what that actually means, from a scenario of how that has played out. And what is becoming more and more apparent, and why I've sort of highlighted China, but not from a trade point of view, but just as a base case, is what comes through on this chart, and why the weekend, from my perspective, was so interesting, is because the targeting of Germany specifically, particularly with his rhetoric around Russia and around what's going on in that scenario, I think is very interesting, from the point of view that, as you can see from this chart, the deficit that has been run by the US in Europe, but also in Japan, to me, is actually a more interesting source of risk than probably what's been happening in China. China will certainly hurt us in the future. Don't deny that. There is, when you've got 37% of your exports going to a nation that is clearly currently battling through this scenario with our largest defence and probably largest ally across the globe, well, there will be an effect on the Australian market going forward sometime in the future. But what is really interesting to me is the fact that the trade balance deficit being run against Germany is actually around about the 5th or 6th largest that they have. And it's building. And if you take the Eurozone, it sits actually currently at around about the 3rd. So the other one behind China is actually Mexico, and then they've got Canada, and the two of them are very close. Obviously, the Americans do consume a lot of gas and oil from Canada, even though they have a lot of it themselves, and then from Mexico, it's cheap goods. But this, to me, what's going on in this scenario right here is what I think is quite an interesting conundrum. And it has certainly been playing out in what you've been seeing here. And this is another way of looking at it, is that, again, the European Union exports a heck of a lot more to the US than the other way around. And it's why you have started to hear more and more rhetoric around, he even singles them out, why BMW, why Daimler, why Volkswagen are going into the States and are likely to face pressure. Now, he says Mercedes, but why I say Daimler, the interesting thing about Daimler is it's Daimler Chrysler. It's joint listed on the S&P and also on the DAX. So it's an interesting one that he may or may not target at that. But you can see with all of what I've just talked about, this has been the effect. And the interesting scenario of this is that basically since his first tweet for us here in Australia, which was the 1st of March, and that's why this one here I deliberately pulled off from the States. So it's on the 28th of February this year when the tweet initially came out. This is the performance of the areas that he's targeted. And you can see very clearly who's losing. And you can see very clearly who's likely to continue to lose with the scenario that's currently playing out in front of our eyes. And that, I think, is probably the more interesting scenario that's going on. And what not only has that led to declines in Chinese steelmakers and EU automakers, etc., is that you've now got a scenario, and apologies, the chart that I had is actually slightly disappeared. If you look at what's going on in euro-dollar, I had been quite bullish on the global growth story, and the euro is probably the best example of a growth currency in terms of what's out there. The renaissance in the European Union last year was very, very strong. The euro really started to take off from about 114, and I was chasing 125. Was pretty happy when it got there in February and was sort of assessing what I was going to do, and the market told me what to do, and that was to get out and to actually start going in another direction, and that was to be short. And you can see very clearly from the chart that I showed you before around the Dixie is that you've had a scenario now where it has absolutely plummeted. And it's now at 115. It's bounced back up to 116, but the trade that I see is that any form of, at the moment, any form of buying opportunity, like sort of upside in the euro dollar, I actually see that as a selling opportunity to be probably short, because I see 115 as a level that it can probably go through, and I can see it going towards 114 and 113, because over the next couple of months, it is highly likely that there will be further talks of tariffs. There will be further talks of the trade deficit with the European Union that the states are running, and the president is likely to say that that risk in itself, even if it's not enacted, will create US dollar strength. And the clear movement and the clear target is going to be the euro dollar. And I'm therefore quite interested to see if there is, as I said, any form of strength and any sort of dip buying that's going on. I actually want to be slightly short that, because I actually see it going through 115 back to where it was basically at the end of 2016 of $1.14, and moving that way quite rapidly. It's an interesting one. I know a lot of people will probably disagree with that, but at the moment you've seen two sides, and what I mean by that is you've seen that the US dollar is getting strength, and that is certainly what's been quite interesting, even though there is, reasons and probably some people suggesting that there shouldn't be. But the Dixie is telling you everything that it wants to be there. So the euro is clearly where I would start to say that I want to be short, and I've sort of clearly laid that out. The other one that I would also like to sort of probably highlight, and as I said, apologies, we're having a little bit of technical issues, is the DAX. The movement in the DAX has been really interesting. I love the DAX because it is perfectly diversified in terms of what theory would tell you. It is, between 7 and 14% in pretty much every sector, being autos, financials, apparel, healthcare, finance, technology, to take your pick, across those 30 companies. But the bigger end of towns are the ones they're going to target. And going back to the chart that I showed you before, this one here, and along with here, is that don't just look at the fact that US good imports from Germany, the big sort of purple bar. Have a look at the services it imports. And that therefore means that you do have things like SAP has a huge presence over in the States. You've also got things like Econ, etc. as well that are over there that have quite a level of service. And all of that could come under pressure if they start to look at it. So the DAX is a really interesting one, and therefore I think if you see it hit 13,000, which is currently 13,200, which is currently testing, you may see it move off that because the risk is building. And again, as I get back to my sort of original thesis in terms of what I've been talking about, is that markets should be and do tend to look forward. And when you're a forward-looking indicator, you should therefore be thinking about what markets will do in 12 months' time. And that's very clearly sort of where we're sitting with regards to what's going on into the future. So apologies that I haven't been able to get my charts to work for you today, but I want to move to us and what all of this means from an Australian-centric point of view, because this is the stuff that we all live and breathe. And I'm going to go a little bit more local and a bit more domestic to talk about Australia, because there are not just the geopolitical issues that we're talking about, but there are scenarios domestically that are quite interesting as well. So where do we sit? And what I mean by that, where as a nation is our central bank sitting? We've spoken a lot about what's going on with the Fed. We've spoken a lot about what's going on with the White House. Where is the RBA sitting? And I'm sure you're all very much up to date with what's been saying and why everybody says that they are the most neutral bank on the planet at the moment. They are sitting very, very, very solidly on the fence. Some people will allude to maybe they were slightly dovish in the minutes. Some people might allude to they could be slightly hawkish, considering that they continue to say that the next most likely rate movement is up rather than down. But this chart on screen shows you very clearly the expectation from the market is moving further and further and further out. So if you had a look at what was expected back in sort of basically around about February, the purple line is the best one to start at. So look back in February, people were sort of strong about it. So I don't want to go back to January. You don't need to, people were relatively strong with 1 year in, and after the first meeting of the RBA sort of telling you that they were sort of fairly positive of the outlook, you know, they were seeing business confidence, they were seeing, you know, NAB business confidence peaking, they were seeing GDP growth pretty good, trade balance was really firing. We had the best level of trade, 3 consecutive months of over $1 billion Aussie dollars in net trade. All that was leading positive, so the market therefore was quite optimistic that basically you would see one full 25 basis rate factored in by pretty much the year end. What has happened, the more and more and more we've moved, is you can see very clearly that the expectation of a rate rise by basically July 2019 isn't going to happen. So the median forecast, although it's still saying there is 1 or 2 believing that it might happen by July, in the main, the market doesn't believe that. And you can see very clearly that even if you go to the back end of that chart with the current level, expectations of the first rate rise to occur is only ever possible now on Melbourne Cup Day, being November next year. And there's only at the moment 4 out of the 30 currently surveyed economists that believe that there will be a 25 basis point rate cut. The majority now are out in 2020. And as that chart shows, at the start of the year, it was much more inclined to seeing that rates were rising. There were even still people forecasting rate rises in May and also in November this year. And all of them are gone. NAB was the last one there, and they finally moved it away. So the RBA, therefore, is basically out of the market. It is no longer going to push markets in either way. It's therefore unlikely to have any form of major impact on the currency. And that, I think, in itself was quite interesting because the currency's been doing some very interesting things. But what is more interesting is why the ASX has been very interesting. And what this is why I've called this Banks and Oars, is that this is, again, thinking on a 12-month basis and where I expect the ASX to be in 12 months, that's how the market should be pricing right now. What are the banks going to do? The banks make up 25%, thereabouts, the big 4 anyway, of our index. And what is becoming more and more apparent from what I like to look at is that their funding side is becoming quite strained. So this chart here is showing 2 things. So when you look at funding from the bank side, and what I try and evaluate with them is they get retail funding from you and I putting a term deposit at a bank, maybe getting 2.5% per annum for a month or 3 months or 6 months, etc. So that comes into that blue line. Now, roughly, and CBA love to champion this, it's roughly around about 2/3 of their total funding for all the lending that they give out comes from resale funding, which is very good because it's sticky, it's cheap, it's simple, it doesn't require a huge amount of effort, and therefore it makes their capital quite attractive. But what we've been seeing, what this chart is showing, is that the deposit growth has been slowing quite rapidly, and you can see that it's now actually below 6%. Now, although that means, it doesn't mean that they're actually seeing necessarily a major decline in deposits being taken at the banks. It does mean that the growth of it is slowing down, and not surprising. I mean, if you were to be told that you can get 2.5% at a bank, inflation's 1.9 to 2%, and then the government's going to tax you on any sort of income you get, putting your money in the bank, obviously over the last couple of years, just hasn't really made sense. So they're either taking their money out of the bank and putting it into it in shares, which you've seen in probably the bank run up in share pricing, or they're doing other things with it. So that means that wholesale funding, which is the yellow bars, comes into play. Wholesale funding is going to the States or going to Europe and going into their money markets, and obviously going and borrowing from there. Or here in Australia, we have the bank bill swap rate. And the bank bill swap rate, I'm sure you've all seen, has been in the news of late with the issues around rigging from the banks. That is all well and good. But what's been happening also, getting back to the start of the presentation, is that I didn't discuss that the fiscal changes from the Trump presidency around, particularly the allowing of the repatriation of US dollars back home for a tax rate of 12%. So Apple's a case in point. They're bringing back 379 billion US dollars off the back of those changes. Means that overnight money funding markets have been moving quite rapidly. And you can see quite clearly that if you look at LIBOR or Eurobor and our bank bill swap rate, rates have been moving up quite dramatically. And they're currently sitting at the overnight rate anyway at 62 basis points. So that's 0.62 of 1%. And this is where the banks fund themselves from. Now, it doesn't sound like a huge amount, but when you're talking in billions of dollars, that's quite expensive. So there is pressure on the banks from the funding side to probably and most likely pass this through. And you've already seen the regional banks do that. I'm waiting to see the big four banks do this. And if it does happen, and I actually suspect it will very much, and I believe definitely, crimp what they're doing and why. Although the ASX has been fairly rigid over the last 3 months and somehow managed to be quite cushioned from the geopolitical risk we discussed before, what you can see is that the outperformance that I'm just talking about has come down here. And that sort of, from that June jump up, is that the banks themselves were actually in correctional territory. The Banking Royal Commission has certainly pushed them. You've had a scenario also where they're over-regulating. You've seen the housing prices in particularly Sydney and Melbourne slow down. All that's come to fruition. But although all of that has happened, the banks have shown that they're still doing quite well and still growing at a reasonable rate and have popped up. That's all well and good. I'm not worried about that. I'm more worried about what's going on here and what might happen in the future. And that's what this chart shows. So you can see that real big bounce off has come off the back of probably being oversold. But that oversold scenario, in my view, I think this underperformance that we saw over the last year is more likely to continue than not. I can't see a catalyst that is going to see the banks really explode and sort of gap up to where they were, and therefore give that ASX the next kick. What has been interesting, and getting back to my original thesis, as I said to you before, is that why we've done so well and why we're sitting at currently around 6,200 points and above on the ASX is that growth parts of our market have done incredibly well. So this is the material index. You can see over the last year it's done very well. There was that big breakout in October. You then saw the average pricing of things like iron ore and copper doing incredibly well at the back end of last year, and production reports are part of the reason this really exploded. And then again, the next level of production reports came out, and also the fact that you've seen a surge in oil prices has certainly helped. You've also seen the fact that there's been a resilience in iron ore despite what's been going on all there. But going back to this chart that I showed you before, in the last 3 months, it's just started to break down. And that again is something that sort of makes me sit up and ask questions to myself about what that might actually mean and how that actually therefore looks from the point of view of, am I now needing to start thinking about the positioning from a defensive side, or am I looking at the ASX from another side that is a more negative one? I'm actually neutral. I think other things will hold it up. I think you've seen that FX tailwind providers will provide support, but I just can't see the growth in the market to go to 6,300 points. I can more see it going back towards 6,000 as there's some rockiness coming in materials, that global growth story starts to slow down, that cyclicality that comes with those players is most likely to filter through, and that's why I am a little bit more bearish on the ASX than I have been, and there's nothing wrong with that, and I probably will change my mind and correct that at the back end of the year as they moderate out, but I do expect it to slow down. What I'd also therefore start to talk about, and again, apologies that I've had some technical issues around this. In fact, I'm actually going to try and bring it up and find it. You can have a look at my desktop. Is I want to actually have a chat to you about what's been going on in the Aussie dollar, and I think it's really, really important to sort of have a look at what this has been, because I think very clearly it's this chart here is that at the moment the Aussie is clearly moving in a direction you should expect it to be, and it has moved away off the back of, again, the Trump risk story came in here. The US dollar story is taking over. You've got a raising Federal Reserve, and I think that's very clear, and so it should be. And the Aussies come down to a level that I actually believe it should be probably fairly at. I still think there could even be further to go. I actually think it's going to 70 cents by the year end, because as that commodity buffer that's probably actually managed to hold us averaging around 75 cents, around 77 cents for probably the last couple of months to a year, is starting to break out. And you can see that risk, commodity slowdown, emerging market slowdown, and obviously China being in a bear market, all that is justifying what's going on here. I actually still see this going further. And the differential between the Fed and the RBA is all part of that. We have not seen a scenario where the Aussie 10-year bond yield and the US 10-year bond yield is in negative territory for 19 years. So at the moment, it's around 25 basis points. You'll get a better rate in the US for their 10-year, which is currently sitting at around about 2.8, 2.9%, whereas ours here is sitting around about 2.55, 2.6%. It means the carry trade is exiting quite quickly, and all of that explains why people are shedding their Aussie dollars. So risk, carry trade, expectations around commodities, and future risk expectations, all that's there, and that's why, yeah, the Aussie dollar for me is the next trade that I'm also looking at, along with the euro, and that is to be short. I'm actually going to stop there. I want to have a bit more of a discussion because I think it's really cool to actually talk about this. I've talked a lot. I know there's been a lot of stuff going over this, and again, I do apologize that some of the charts haven't come through, but I would really like to have a bit of a chat, because I think it's better to actually take your questions and follow through with them where I can. So if you do want to sort of click onto your GoToWebinar panel and click on the questions, if you do have any, please start flicking them through. If you don't mind, I'm just going to have a quick drink. Okay, so has anybody out there got any questions for me? Here we go. So interesting question. First question comes from Jenny, and it's, should we focus on stocks that have US exposure? First of all, Jenny, I'm going to have to say, obviously, I can't give you personal advice. It certainly has shown, if you look, and what I'll say, I'll go specific to some point, have a look at what has added points to the ASX since basically April. So they are, have a look at things like CSL, have a look at things like BHP and Rio, have a look at things like Macquarie. They have certainly seen quite a nice tailwind off the back of their currency denotions and have done quite well. As I said, BHP and Rio obviously have the growth side upside. Their production reports they've released in the last sort of 24 hours or today have certainly been very, very strong. So I do prefer to have exposure to the States, whether that's through an Australian listing that has growth opportunities over there, and I haven't even spoken to you about the builders, is one way, or looking at the US themselves. So that's probably the way I would look at it, and probably the way I would probably answer that question. Great question. But yeah, I would probably look at them and give you your examples and make your decision from there. Next question came from Gregory. Do you see any further risks with bank regarding the interest-only loans? Yes, I do. And I think what I'd probably answer that question, Gregory, is that the banks themselves have seen that. You've seen, and again, I hate highlighting, but Westpac's the case in point here. So if you had a look at them this time last year, or basically early this year, almost 50% of their loan book was interest-only loans. And they have very much addressed that as hard as they could, which is they cut their principal and interest loans to basically attract players across from interest-only and raised interest-only and investor loans. It's a risk to the bank to have interest-only loans. Again, having a property market that is showing some signs of decline, having basically no pay down of principal is a big risk for their balance sheet. And the one thing and part of the reason why they continue to tell you cash earnings are so impressive is that their bad and doubtful debt is very, very low. In fact, for things like NAB and CVA, it's at record lows. So that is the interesting conundrum here is that, yes, I do see interest-only loans as a problem. The banks have already addressed it and are starting to see it. I'd be more, what I see with the banks is if they do raise rates, and I believe that they will, what does that mean for household spending, and what does it mean also for that possibility of bad and doubtful debts to rise? And that's the conundrum the banks are facing. And then getting back to what we do, being obviously traders, is what does it mean for the bottom line? What does it mean for cash earnings? It's why I just feel a little bit of capping out can happen in the banks, and the possible upside in banks is not as blue sky as it probably was 2013 through 15 as it is now. I hope that answers your question, Gregory. Next question came from Ron. Have you got a view on the pound, and Brexit may play out into that? So I think they're interlinked, Ron. To be completely honest with you and answered, I mean, I remember sitting on the trading desk watching Brexit play out. It was sitting at 150 and watching, this is a cable we're talking about here, go from 150 all the way down to, it even gapped down to as low as 118. It was just an extraordinary day. And if you look at particularly the last 6 months, and the trials and tribulations that the May government has been going through with Brexit, the pound has responded in kind, unfortunately for them. They have seen some weakness. You then also throw in, what happened last night, and the fact that when the cable reopened after the weekend, and what Trump had to say around the possibility of a UK-US free trade deal, etc., also plays into it. So I find cable at the moment very, very hard to look at, because it is so heavily impacted by Brexit, and it's so still interlinked, and probably will be for the foreseeable future. I'm much more interested in euro dollar for that reason, because at least I've got one side of the equation which is economically more interesting, and that's the European Union. I find that what's going on in the currency, as I said, in the sort of the White House place, is that it's more to do with rhetoric coming out of the White House and whether or not you're going to see tariffs coming at Europe. So that's probably my view at the moment of GDP. Next question comes from Alan. Do you look at leading indicators, i.e. yield curve? Yes, I do, for entry and exit of timing. Yield curve is an interesting one. Alan, I could give you a whole hour talking about that. Very, very quickly, I assume through that question, looking at what you're doing and what you're talking about, is the indicators that come from there are things like the 2- and 10-year bond yield. For those of you that don't follow it that closely, the inversion of the US 2-year and 10-year bond, so where the US 2-year yield is higher than the US 10-year, has over the last basically sort of 150 years of the S&P has seen a technical recession and a bear market. Now, people will point to 2004 as one time that it didn't happen, but you can actually clearly see that there was a fairly sharp reversal very quickly, and then it picked back up again because those were the fairly good times. But they did actually technically correct very hard, and the US did have a technical recession. So I do look at the yield curve, and I'm sure you're alluding to the fact that at the moment it sits at 33 basis points. So it is very, very flat. And probably what I said before alludes to it. We know the Federal Reserve is raising rates over the next 2 years, so that's why the 2-year is moving up as it should be. But the 10-year is the pinnacle of safe haven asset on the planet, and geopolitical risk is probably depressing it. Most believe that it will snap out of it and will follow the Fed up. So most people believe by the end of the year, the US 10-year will probably be about 3.2, 3.5%, depending on who you listen to. But at the moment, it has remained depressed below 3% because of risk, and that is why it's getting narrower and narrower. Apologies, Alan. There's a lot more I can tell you about that, but I hope that answers your question. Next question comes from Tobias, and that is, do you see government spending in Australia having a growth effect? Tobias, to be totally honest with you, it actually already does, and it already has. And the reason for that, if you look at part of the reason why we've had 27 years of consecutive global growth, consecutive growth, is because government spending is quite high, and it has remained so. It started to ever so slightly slide off, and what the RBA has been alluding to that it's so happy with and so proud of seeing is that private investment has started to slightly pick up the slack after the mining boom. But in the main, yeah, government spending is clear. Both sides of politics, whichever you listen to, want to do some form of spending, whether it's on infrastructure on the Liberal side, whether it's on things like hospital construction and education on the Labor side. Infrastructure is core, and both of them will continue to want to build, particularly roads and some form of transport infrastructure. That is clear. So yes, government spending will continue to be a pillar, basically, of our growth. Now, whether you believe that or not is a good thing, because clearly they're going to have to go and borrow that in some domains. And if you look at what happened in the budget this year, they told you that. But infrastructure does create stimulation, it does create growth, it does create jobs, and therefore it filters back into the economy through wage growth, through stronger wages, employment, inflation comes about on the back of that as well. And so therefore, it isn't a bad thing that government spending, it's whether or not they can find a way to actually offset that by the growth coming through in other areas, as I just explained. Oh, I always get this question. So I'm going to put this out. So I hope I pronounced your name correctly, Wally. It's given your presentation as a backdrop, how do you see gold prices moving? So I'm going to put it straight out there. I do not follow gold. And the reason I don't follow gold is because there are so many factors going into it. It's an interesting one. The theory would suggest that given the risk in the markets, gold should be going up, and it's not. And the reason I would answer that is that the other theory is that you want to be looking at it from a scenario around hedging against inflation, and inflation is starting to materialize, and that's why the US dollar is outpacing it. I'm not going to answer any more than that, I'm sorry, Wally, because it's just something I don't follow. Next question again comes from Gregory. Very interesting. So implications with Westpac pulling out of the SMFF lending, further implications to consumer businesses. Probably a little bit granular for this. I'll probably have to go offline. I'll happy to sort of get Chris to send that question through, and I'll come through to another time, Greg. They are there, but it's probably something I can do at another one. So I'll probably a couple more questions to go. So this is coming from Selena. Given what you've discussed and the Fed's dot plot, where do you see the US dollar going? So I'll actually deliberately go back onto here and so I think this is probably the clearest way to show it to you in terms of what I see going on with the US dollar. I see the US dollar as actually being fairly strongly bid up at the moment, particularly against risk. So Euro dollar, cable, Aussie dollar, Kiwi dollar, etc. I see them as risk currencies, and I see them having a fairly rough time against the US dollar. The Fed is raising rates, as I said before. The differentials between central banks is first case in point. And as I explained, The Aussie 10-year to the US 10-year is negative for the first time in 19 years. And what I didn't say when I was alluding to that before is that the last time that happened, the Aussie dollar fell to 50 cents. Now, I'm not suggesting that's necessarily the case this time around, but there is certainly a negative carry trade there. The possible volatility in commodities, and I'd probably point to copper. Copper's an interesting one. It's collapsed about 15% in 6 weeks, and I think that's probably a little bit overdone, but it's certainly an indicator to me that maybe the world and the markets are waking up to the growth slowing down. And again, that's another indicator that risk currencies are going to probably suffer from it. Then the tariffs on top of it, and euro dollar, and the reason I really concentrate on euro dollar, it's the most traded currency on the planet. It has the biggest impact on Dixie, along with the pound. That movement around what is going on in that space is why I see the US dollar as probably a bit of a bright spot, and tend to be long risk currencies. What you can also see from this chart, though, is that you can see that the Swiss franc and also that the yen have maintained themselves, which is quite interesting in itself, which suggests that those that are really risk averse are already also exiting out of the US dollar as well. But with that, I would probably say that the best way to look at it if you are going to put a trade is that the markets are showing that they've trying and want to be short risk. I'll probably have a look at this as probably the last question before I hand back to Chris. This is coming from Jenny. Do you see bank deposit rates rising given the cost of bank money? Actually, that's a very good question, and you've actually seen that happen a couple of times over the last sort of 18 months. They have been trying to attract people in by raising interest rates on their term deposits. Again, the funding mix at the banks is a very interesting, delicate conundrum. They call it the triangle, and what I mean by that is that the CEOs will allude to shareholders, lenders, so mortgage holders, business lending, etc., and then also their term deposit money market holders. And they try and move things ever so slightly so that each one has a benefit, or if they're going to take away from one, they do it for a short period of time. So there is no doubt, as I said, that retail funding is sticky, it's cheap, and it's simple. That raising, term deposits completely out of cycle to maybe even as high as 2.8 or 3% would probably help them, considering that some of the funding from the States could be as high as 4.5% by this time next year, all things remaining equal with what we've been told. So that is certainly a chance in terms of what we see there, Jenny. With that, guys, I'm going to hold there. Thank you so much for listening, and I hope, again, apologies for some of the technical issues that I had with my presentation, but I hope you found it informative. If you do have any questions, please just sort of send them through to Chris and through the chart that you see on screen. I'm sure he'll be able to help out. And otherwise, I'm always on Twitter, and you can certainly get to me there. My Twitter handle is EvanLucas_INV.
Thanks for that, Evan. And as Evan has said, if you do have any comments or feedback, you can send them through to support@fpmarkets.com. Those bonuses do still apply. So if you get a moment, feel free to jump on the website under the About Us section and the promotions. You'll be able to find all the current promotions. That's all we've got time for today. Once again, just like you guys, thank you for coming out, and hopefully see you all at the next webinar. Thanks.